shortly. We have quite a few people that are logging in, so thank you so much for your patience, and we'll be with you shortly. All right, we're going to go ahead and get started this morning, and thank you so much for all of you that are on the phone. Appreciate the time that you're taking in attending today's webinar. It's going to be a great webinar on buy-sell agreements. I really like the title, Buy-Sell Basics, Don't Leave Your Business Owners Up a Creek Without a Paddle. I think so many business owners get so busy and are so wrapped up in their own businesses that a lot of times they don't think about business continuation and the importance of it. And today I'd like to introduce Marilee Talley. Marilee is a COU, CHFC, and Regional Vice President with Genworth Life. And what Marilee currently does is she works exclusively with brokerage general agents and their brokers and advisors and really helps them to identify or, develop ideas that work in solving clients' financial issues. Marilee speaks extensively to both consumers and financial professionals in the areas of estate and business planning and on the topics of general personal financial management. So she and her internal wholesaling partner, Kathy Murrell, they are amazing, provide great service, and they are also readily available to help behind the scenes in getting Genworth cases completed and out the door. And Marilee, which is kind of funny, a person close to my heart here, she and her husband and their Labradors live in Denver, Colorado. Marilee, I'm really excited about this webinar, and I think we've got great participation here. Anxious to see the information that you're going to present today, and thank you so much for taking the time out of your schedule as well to host our webinar. So I'll let you take it from here.
All right, Sherry, thank you so much for that lovely introduction. I'm delighted to be here. Business planning and the insurance needs within businesses is one of my favorite subjects because it is generally easier to get the business to strike a check than it is to get a personal check from someone for life insurance. And I've always really enjoyed the intellectual challenges of it and also the fact that it's just a little bit easier sometimes to make things happen inside business. So let's talk about buy-sell agreements. This is an extremely important issue for any closely held business. Hang on a sec here. What it does is it creates a market, in essence. It's an arrangement for the orderly transfer of a business interest in the event of death, disability, retirement, or divorce. Any contingency that you want to put in there, you essentially can. It is appropriate for any closely held business. So we can do a sole proprietorship, and you say, well, you know, who do we sell the business to? Well, we can think creatively here. We can sell it to a competitor across town. We can sell it to perhaps a key employee. A partnership, an LLC, which is a relatively new form of business, C Corps and S Corps. If they're closely held, in other words, they're not publicly listed, there's only a few owners, this is an issue that people should be thinking about and reviewing on a regular basis. What it does is contractually establish the market of a buyer and a seller. It identifies who the parties are for what is really an illiquid asset. If you've got two parties in a business and one of them dies, the widow of either gender may know nothing about that business and have a professional career of their own. And now they're trying to get the best value, get some money from it, and all of a sudden they're at odds with their spouse's former partner, because obviously now there's two sides of the fence and there's some conflicting desires. The business owner wants to hang on to all of his money and get control of the business, and probably the spouse at this point really wants to get as much value as possible. So you can get a lot of bad feelings going if there is not an agreement in place that addresses this situation before it occurs. What a good buy-sell agreement also does is establish the price, or probably more likely the formula for determining the price that will be used. So the business owners come together and say, all right, here's the method we're going to use to value the business if and when the time comes that we need to trigger this agreement. The best ones also mandate funding. And one way or another, no matter what kind we set up, and we'll go through what some of the common types are, no matter what kind we set up, the business can pay. It may pay by pushing out a bonus to the individual who then establishes the funding personally. It may pay by buying the insurance within the business entity itself. But again, as I say, it's always easier to get a check out of a business than it is to get one out of an individual. So therefore, a buy-sell agreement protects all interests. The owner or owners buying the interest is assured of getting full control. There's going to be no new owner or partner who suddenly shows up and says, well, you know, I own half this business, where's my desk going to be? The family of the deceased or the retiring owner is also assured of having an entity to sell the business interest to and for an agreed upon price. So family harmony and business relationships are preserved. Do not underestimate the value of this. Particularly in intra-family transfers, it can be an absolute snake pit. There's some interesting stories around it. Can you imagine a situation where they have agreed to have a buy-sell agreement, and I ran into one of these once. The thing triggered, and it was three partners. One had died, and the other two are standing around saying, my gosh, we owe the widow, we owe the estate technically, but we owe the widow $475,000. We have no idea where we're going to get the money. They're on the hook now, and they did not identify or prepare a funding source. Additionally, I heard another story. I was talking to an attorney about 2 weeks ago, and it was just the opposite situation. They had the life insurance in place, was cross-owned, which means owner A owned the life insurance on owner B. Owner B died. There was no agreement. The widow came looking for the money and said, you know, I want to sell the business to you. And he said, I don't think so. Apparently, they went to court twice, and the court agreed both times there is no enforceable agreement that's been signed. You guys are going to have to thrash it out. So you could argue that either way. You could say the widow is in the driver's seat because she can simply show up on the door, camp out, and say, you know, let's get a desk going. I want to be involved in the decisions. You're going to pay me my husband's salary. But she might not be in a position to do that. So it's very important that you have the whole package put together to keep everybody happy and everybody behaving themselves, in essence. Now, why does it matter? Why is this so important? Well, let's look at some LIMRA statistics. 82% of closely held business owners are over the age of 40. And here we have the probability in just a pair of business owners. You know, it goes up much higher if you've got 3 owners, 4 owners. But you can see the probability of the death of one of these partners before age 65 is extremely high. At 40, it's 35% that one of them will not make it to the age of 65. That's going to trigger a whole cascade of problems for the families involved and certainly for the business. According to LIMRA statistics, 39% of business owners overall are going to see a change in ownership within the next 5 years. Most of those will not be planned. Here's where we have an opportunity to step in and help. If your client base is business owners and you've been dealing with them from the standpoint perhaps of the health insurance market, it can be a very easy transition to a small business owner to say something like, thank you for your trust in me. We've solved this issue for another year. Something comes to mind that I think is extremely important that I'd like to talk to you about. What do you have in place for an orderly transfer of the business? So it's a way to step in to just a terrific market and really be an advisor to the business owner and really help plug a terrible hole he may have in his planning. Okay, so how do these work? Well, there's three main kinds that we're going to go over. The first is a cross-purchase, where the owners themselves individually purchase the business interest. The business is not involved in the sale. There's an entity purchase, or it can be called a 302 stock redemption, where the corporation purchases the business interest from the estate of the deceased. And there's my personal favorite, which is a wait and see. It's a combo, just like you get at Wendy's. This provides the option to make a decision which way you're going to go when you need to make the decision at the time of execution. Which decision is right for a business will depend very heavily on what's going on in the business at the time and what the tax situation is. And we all know, if there's one thing Congress can seem to get done, it's change tax rates and tax rules frequently. So it makes a lot of sense to preserve the flexibility to make the decision that either the surviving owners will purchase the asset individually or the entity will purchase. It makes a lot of sense to make that decision at the time of need rather than perhaps 10 or 15 years in advance. That's my personal bias, and that's the one I recommend for every time. But let's go through what these are, because certainly the wait and see has each of these first two elements in it. Now, my apology for my very rude graphics over here. I'm not that good with PowerPoint. But let's look first at the graphics where you see business underlined on the right. What's happened here is the business is not part of the transaction. We have owner A, and owner B is the person who's died. So what happens in this case, business is, again, not involved. Owner B's estate agrees to transfer the shares to owner A directly in exchange for the agreed-upon purchase price. The owners own the funding on each other. So life insurance is the best course of funding, and the other reason I love this, working in this arena so much, is that even the most recalcitrant CPA, and they have gotten a lot better about educating themselves on business issues beyond the income statement and the balance sheet, but there's still some old school out there whose job it is, they think, to say no. But even the most recalcitrant CPA, when you work through the funding alternatives, will agree that life insurance is the best solution. A little beyond the scope of what we'll be talking about today. We can talk about that another day. But in this case, the owners would each own the policy on each other. I ran into a very funny situation when I was fairly new in the business. I think I was following a Prudential agent around, and heaven knows his heart was in the right place, but his execution was kind of poor. And I was talking to one of the partners, and he said, yeah, we just finished our buy sale, and I'm thinking, oh, crap. But I asked a few more questions. He said, well, we have a cross purchase. And I said, is it funded? He said, absolutely. He pulled out his policy, and he said, here's my policy. And I looked at it, and it was a policy on himself for the purchase price. And I said, how's this supposed to work? He said, what do you mean? I said, well, explain to me how this works. Your partner, Ted, dies, and if you're owning the life insurance on your life, I assume he has it on his. He goes, yeah. So where do you get the money to buy his shares if the money is flowing into his estate? And there's dead silence. And then he says a bad word, and he says, I better call my CPA. So there's some real opportunities out there, even if people think this has been handled. But the advantages of the cross-purchase are the insurance comes in income tax-free, and owner A gets a step up in basis. That's not as big a deal as it used to be because the unified credit is now up to $5 million and it's portable, so we've got a lot more room and there's a lot fewer businesses this becomes an issue for. But I still, again, my bias is always for the personal ownership and for personal purchase, all else being equal, simply because a step up in basis is a nice thing to have if the surviving owner wants to turn around and sell the business in the future. He has more basis in the business, which means there's less capital gains that he'll pay taxes on when he sells. This has no balance sheet impact to the business, and that means there's also no possibility of corporate AMT exposure. The disadvantages, you want to keep a close eye on the partners. Maybe you have a funding party every year where the partners bring in their insurance statements so that everybody can be sure that each owner is indeed funding the policy as he's supposed to. An owner may be in a higher tax bracket than the business, and then multiple policies are required if there's more than 2 owners. The formula is actually X, you see it written there. Let's say you have 3 owners. What that formula says is that 3 owners times 2, you're going to need 6 policies. And of course, it just gets bigger. If you have 4 owners, you're going to need 12 policies. I think this is something of a red herring because it can be easily managed with a trustee buy-sell. That simply means there's 1 policy on each owner, and it's held in a trust for the business purpose. So that's kind of how a cross-purchase works, and a little bit about the pluses and minuses. Let's move on to the entity purchase. You may also hear it referred to as a 302 redemption. The business owns the buyout funding. If we look over at the graphic, we see that this time it's owner A that is not involved in the transaction. The parties involved in the transaction are the business itself and the deceased or the retiring person or his estate. So here we have owner B, killing him off again, and he sells the estate, sells the shares to the business, and the business pays directly to the estate. The advantages are it's very simple to understand, especially when there are multiple owners. The business controls the funding directly, so it's simply a business check writing the insurance premium, and there's absolutely no question, each owner can tell very quickly that the appropriate policies are being funded. The disadvantages, though, are that there's no step-up in basis for the remaining owners. You may possibly trigger a 15% corporate AMT tax. And if the insurance proceeds land in the middle of a troubled business that has creditor claims, there could be a real fight for the money. The creditors may go to court and say they've got first choice of the money, and the buy-sell funding, therefore, there's nothing left for the surviving owners to buy out with. So those are some of the disadvantages. Let's look now at the wait and see. And come on. Hang on a sec. Don't seem to be. I think I've got a screen that's locked up here, folks. Yeah, I've got a screen that's locked up. Seth, can you help at all or not?
Marilee, just one moment, and I will see if we can assist with that. Just one moment.
Okay. Tell you what, let me try this. Technical difficulties.
Marilee?
Mm-hmm.
Try just clicking on the actual PowerPoint tab down at the bottom. And then click on,
go back in.
And then click on, see if you can go back in.
Let's see what happens here.
And then start at the one that you were at, and then see if you can go ahead and get it to proceed from that point, because it's actually on your end.
Okay. All right, we're getting down here. Let's see if we can.
Thank you for your patience, everyone. It'll be just a moment.
My apologies. I think we're back in it. Okay. Let me try a page down. There we go.
Perfect.
Okay,
Great.
Thanks. Sorry about that, everybody. The wait and see incorporates both of those previous types of buy-sell that we talked about. It postpones the decision until execution. And there are 3 steps in the agreement, and they're very important. First, the corporation has the first option to buy. So it would be an entity purchase option. This may last. They've got 30 to 90 days to execute. You notice option there is in italics. It cannot be mandated. Then, if the corporation does not execute, the shareholders have the next option to purchase for the next 30 to 60 days. If they let that expire and do not execute, The corporation then steps in and is required to execute in an entity purchase. Now, you do not want to have the shareholders being required to purchase, because if they then do not purchase and the corporation steps in, what you've created is a dividend. And that's the last thing anybody wants, because that's taxed twice. That's taxed once when the business pays it out to the business, and it's taxed again when the shareholders receive it. So you want to set it up as corporation has the first option, shareholders have the second option, and if they do not execute within the time frame, then the corporation steps in, required to purchase. This allows the facts on the ground to guide the best choice at the time of exercise. I prefer to see funding owned by the owners individually. I like it paid into the corporation if the corporation wants to effect a buyout, because it increases basis in the corporation, owner's basis in the corporation at this point. And as I said earlier, remember, one way or another, the business can pay for it. I've talked about that a little bit, and how the business pays for it is if Sue's premium on her partner Don is $2,500 a year, the business can bonus Sue the $2,500, or it might bonus Sue the $2,500 plus the estimated tax on that amount. So it is one way or another a business check that can pay for this insurance. And I just, my bias again has always been, I like to see the funding owned outside the business. Okay, what else is important in a buy-sell? The agreement should specify a method for determining value. This is critical, especially if you're passing a business to a family member. The IRS might challenge a sweetheart deal. If you've got a $10 million business and you're up working in that area where the unified credit really doesn't cover the full amount, they're very suspicious of sweetheart deals as you go from parent to child. They're not so suspicious of brother to sister, but anything that moves from grandparent, in other words, down or up the line, that they will take a good hard look at. If they don't like what they see, they may declare it a sham transaction and impose additional estate costs. The agreement should specify a method of funding the agreement. There is no tooth fairy, but as I've said, there is life insurance. You can go either of two directions. Term is a lower cash flow that's required. A lot of people say it's less costly or it's cheaper. No, it's not over time, because it does not take into account the cash value that builds in a cash value policy that can be used to offset the premium in later years. But there are certainly businesses that are strapped for cash, and if you haven't got the cash flow, far better you should fund with term insurance than not fund at all or ignore your buy-sell needs. Permanent is my preference when the business can pay the freight. It's higher premiums up front, but the advantage is your cash value accumulation can be used to fund a living buyout. Let's say we've got two partners, 5 years, 7 years apart in age, certainly not unusual. And if nobody dies in the 20 years that they've been funding this, and they get to the point where the older partner says, you know what, I'm done. I'd like to structure a retirement buyout. Well, at this point, the cash value inside the policy can be used as kind of a down payment on what the remaining partner is going to owe. So that I think is a huge advantage. Additional reasons. It provides heirs with some assurance they will receive a fair and full price for their business interests. If we leave it to a sinking fund or, well, we'll just borrow money at the time, that's not going to give the spouses a very comfortable feeling. It gives both creditors and employees confidence that the business is going to continue beyond the death, disability, or retirement of an owner. Here's a big one. Creditors may be more willing to extend credit to a business that has a funded continuation plan in place. Can you imagine, even if they've already got a line in place and it's tapped periodically, if a key person, a business owner, dies, all of a sudden that credit line could dry up because the lenders are very concerned about the future of the business. Not only have you lost an owner, but you've lost the key services that he's been providing. So a funded buy-sell agreement can go a long way to mitigate that concern on the part of lenders. If cash value life insurance is used in the agreement, the buyer can opt to use any cash in there to help purchase the business interest when an owner retires or otherwise leaves, as I just mentioned. And in the meantime, the policy owner can access the cash values via loans or withdrawals, subject to, obviously, policy limitations and any restrictions in the buy-sell agreement itself. Might be worth putting a few in there just to make sure there's always going to be a funded policy. Now, what do you say to get yourself involved in this? If your practice has not been strictly business insurance planning, executive benefits in that realm, but it's been more from the medical side, or you run into business owners from a P&C approach, because you run primarily a P&C insurance agency, or you have multiple clients and some of them are business owners and some of them are not, this can often seem like a very complicated system, very complicated issue to know about, and for fear of being found ignorant, we end up not asking the questions. So here are some things that can just open the discussion. First of all, it is critical to be seen as an advisor, not a vendor. You cannot be going to business owners hat in hand, sort of as a subservient person, and expect them to open up, because now you're getting into the heart of what's really important to them, and that's their business. That's their business and what supplies the value and the meaning to their life and puts food on their table. So you've got to be an advisor. You go in as an equal. Some of the things you can say are, John, what provisions do you have in place to get the value of this business to your family if you die? Or what arrangement do you have to assure that if something happens to your partner, Ted, you get full control and value of the business and don't have Ted's wife, Sue, as a sudden partner? One of my clients said it best. I learned earlier as a young man that my partner's wife is not the same person as his widow. The needs change dramatically. I have stolen that quote because it was said to me when I was about 2 years in the business, and I have been using it for the 20-plus years since. There's an old joke in our business that we sell by backing up the hearse, meaning we paint a picture of what it's like when the person we're trying to insure dies. This is a golden opportunity to back up the hearse for the partner. Kill the partner off and make him really feel the pain of having the son or the family suddenly involved in the business with no way to get rid of them. Is that really going to be in your best interest or your business' best interest? Next question would be, is your agreement written down? What is your understanding of how it works? Does it specify a price? When was that price or formula last reviewed? Is your agreement funded? How? When was that last reviewed to be sure it's keeping pace with the business growth? Another question not on here, but one that I think is very important if you're starting to get some yes noises and yeah, I've got an issue and yeah, somebody should be looking at this. The next thing I would ask is who is involved besides your partner, Ted, of course. Who else is involved in your decision making on this issue? You want to get the attorney. You want to get the CPA. You also want to find out if there's another agent he works with that he's pledged to. Because at this point, where you start setting the expectation, what I would like to do, what I will offer to do, is do a full review for you. And if I do this and we get back to you, we'll find one of three things: that everything you've done is correct and still working, even though it hasn't been looked at in 5 years. The values are right and it's still exactly as it should be. We may find it needs some updating, or we may find we've got to start over from scratch because nothing's been done in the first place. I will sit down with my team and make some recommendations. When you are satisfied that we have created the best document for you and your partner, what I would ask in return is that you place your business with us. Is that a fair question to ask? So you need to be in a position to ask that, and you do it by smoking out very early who else is involved in this decision. Because when you start talking about some of the big dollars that are involved in some of these business sales, man, it's like blood on the water. They will start coming out of the woodwork. You will find the nephew who has been licensed for all a week and a half has just come to Uncle Bob, and now he wants a piece of the action. So my advice is to kind of set some expectations that you are the go-to guy right from the start. And again, it does come back to positioning yourself as an advisor, not being a vendor to them. That's not going to work. Then what do you do? Well, get a copy of the buy-sell and any policies they already have. Determine the ownership and percentages, the form of business, the approximate value. And at this point, the business owner's gut feel is a good place to start. Determine if there are multiple owners, who gets what share if a business owner dies. For example, you may have a situation where you've got a parent and child in the business and then an outside partner. Well, maybe the understanding is that when dad goes, child gets the business. So be sure you get that clarified. Don't make assumptions that it's going to be equally spread. And then take all this information, contact your insurance network rep. We'll identify for you what additional information is required and guide you through probably the next steps, which would be setting up conference calls with the clients, the attorneys, and the CPAs. Perfectly able to and eager to help you through with this. Now, here's a little bit of a case study that can show you how this works. Do I have time, Sherry, or
Absolutely, absolutely.
Okay.
Please do.
Okay. We've got Maria and Fred, 42 and 40, so kind of right in the sweet spot. They're co-owners and partners in an internet consulting company, and they've spent 5 years building this successful business. It's worth $1 million, and typically, as Sherry said in the beginning, so busy working in the business, they haven't really worked on the business. They just haven't gotten around to a buy-sell agreement yet. So what do they need? This is basically what we've already gone through, the financial flexibility to help them and to be able to protect their families and the surviving business owner. So let's not go over this again. Let's cut to the chase. We're going to do a cross-purchase here. Well, each will own and be the beneficiary of the policy on the other. Remember, you don't own your own life insurance for a cross-purchase. Each policy is going to be a $500,000 death benefit, and that represents the current value of the $1 million. If the policies are not needed, they could be sold to the owners or given as a bonus later down the road. The policy value grows tax-deferred, and we're using an IUL here, so it has an index-linked interest crediting strategy. Maria's premiums are $2,200 a year. Fred's are $24,000. And here we see that I think this is run at 7%. Yeah, 7%. After 20 years, you can see that you've got more in the policy than the premiums that you paid. This is where I say an example of why term insurance, it's incorrect to refer to term insurance as cheaper or less costly. There's less cash flow required, but it is certainly not cheaper or less costly. That does not have a return of premium feature with, bonus the longer you hang on to it. So we can see that if they decide to get out of the business after 20 years, they'll be 60 and 63, I think it was. What we can do at that point is push the policies across to each other. There's no transfer for value problem. Or you can cash it in and get the money back. It's whatever the business owners want to do. And in the meantime, they've got the protection of $500,000 each should one of them die. There's a graph of how it works with the premiums that are going in, the net cash surrender value, and the death benefit. It's a very, very cost-efficient policy. And then we do the same thing for Fred's, which I don't think the specifics are quite as interesting as what we have allowed them to do by protecting their business, creating the funding for the purchase of the business by one owner in case the other dies. We have the income tax policy value growth, which we expect will exceed premiums paid in beginning in about year 18. We have an index-linked crediting potential, so there is no downside performance risk. There is only upside. We expect this to do between 200 and 300 basis points better than just a current assumption UL over time. And we've created financial flexibility for the business's future. Any questions on what we've done so far? That kind of concludes the presentation.
Marilee, it seems like that, and what we will do for the individuals that have actually been on the call is we will actually contact them and answer their questions. But probably the biggest question that I'm getting multiple times that I'm noticing here is, are these slides available? And if the slides are not available, are there areas as far as resource areas on the Genworth website where individuals can find this information? Would probably be a good question to address. And obviously here at Insurance Network America, our marketing consultants can pull up any information necessary, and we can go ahead and do so for them. And we actually have some pieces here that our marketing consultants can actually provide to those that are on the call as well, because you mentioned some differences as it relates to cross-purchase or entity agreements. So please feel free to call in afterwards. Speak to our marketing consultants. As you know, our phone number is 800-456-7999. But Marilee, are these slides available?
The slides themselves are not available, but what we do have, we have a white paper on each of these buy-sell agreement types, and we will get that to you, Sherry, and you can email those out. They go into a little more detail than the slides do. The one slide I can and will make available, and the reason it's not available is because it's not compliant. This was built just for you guys. But the one that I can give you is what to say. What do you say? Because I think there's some value in that, and I don't think that's a compliance issue. So I think part of the problem is, it's easy enough to identify the clients, but how do we get the conversational ball rolling, and how do we get people to open up and to talk to us about the problems. So
I think that's definitely a pertinent piece. And for those of you that are on the call, anytime that you are venturing into discussing an area that maybe you don't feel that you are the expert on, we don't want you to feel that you have to back away from this topic. There is so much information that we can provide to you and prepare you so that when you go into your client meetings, that you will feel like the expert. And between that and our relationship with you, Marilee, we can go ahead and get any questions answered that we possibly can as far as assisting all of the agents on the phone as far as being able to do so. So
absolutely. We've got an advanced sales department that is ready and willing to talk to you and your clients' advisors.
I think it's very interesting that you mentioned one thing that I'll bring up. Let's say that you have two business owners and they aren't in the age group of the case study where, you know, you've got one that's 40 and maybe one's 42. Let's say you have one that's 40 and one that's 60 and they're going to do a cross purchase. Well, that 40-year-old buying the policy on the 60-year-old is going to be paying more, you know, higher premiums than the 60 purchasing on the 40-year-old. It was interesting that you said, yes, you can go ahead and take business dollars and, if anything, bonus them or bonus them in addition for the tax ramifications as well. So, you know, again, all of you on the call, there are ways to get this done where, you know, it's going to assist you in the sale because these topics are going to come up and we can help you out most definitely. So I thought that was interesting.
Yeah, and it's a fun arena to work in. It really is.
I think that is the main question. Again, we will get back to all of you as far as your additional questions that you've asked, but the bulk of the questions were, your slides were so great, they would like a copy of them.
Oh, I appreciate that very much. I'll try and get them complied, but if you've been in the business for any length of time, you know that could be any time between now and the end of the decade.
True,
I'll
true,
work
but
on that.
Getting those white papers, I think, will be a good first step. And I would just about say, as you mentioned, whether you're a PNC agent, whether you work on the group health side, or whether you have a mix of individual and business owner clients, we can help you with this. Call again, speak to our marketing consultants at 800-456-7999. I want to thank all of you for being on the call. Please call us if you have a particular business that you would like to go ahead and get some information ahead of time. Maybe go present the idea, talk to the business owner about it, and gather as much information on your end, and then we can help you bring that sale to a close and get you all the details and info that you need to have a successful meeting. Marilee, thank you so much for your time as well.
My
and
pleasure.
I hope that everyone has a wonderful day, and call us if you have any questions whatsoever. Thank you again.
Thanks, Sherry. Thanks, everybody.